Hi, this is Drew Tignanelli. This is the beginning of our investment education process. We call it Consulate U. And the reason we wanted to do this, Chris, is to begin to just try to explain more about how investments work and why we do what we do and how we think about things. But in order to really start ramping people up to get to the point that we can really start laying out some more of the specifics, we got to start with the big topic.
Sure.
The generals,
Yeah.
The generals.
Oh yeah, exactly. We've been talking about this for a long time. This is how we communicate. This is how we think about it.
This is how we think about it, and we call it. In the article that came out that started it was called the Universe of Investments. Right. And the Universe of Investments was something that I came up with the term way back in the mid 1980s. And it has been a guiding principle of understanding investments and so forth and making investment decisions. And especially when you get all these investment concepts being brought to you,
sure.
Saying, here's a great idea. A lot of our clients don't realize how many solicitations we get either from seminars we go to, via email, via telephone.
Sure.
I'd say every day I probably get 15 or 20. When I consider the email ones.
Sure, I get about half of that.
And then you get people calling you up and saying, I'm the wholesaler for this mutual fund or this super duper investment or this super duper investment. And I want to come in and meet with you and tell you all about our super duper investment.
And they're not linear. They don't come the same place. They come from here and here and here. They come from every angle.
But to really sit back and think about what are they saying? What is really involved in this? Is it really a good idea? You always start with the universe of investments. And that's what we're going to talk to our clients about tonight. And so let's start. And in order to get the grasp of the universe of investments, you have to understand the concept of risk. Now, that word is used broadly, like everything in our industry.
Sure.
We use words, the same word to explain 52 different things, like annuity.
Yep.
Annuity, got tax sheltered annuity, immediate annuity, variable annuity, index annuity,
sure,
non-qualified annuity, fixed annuity.
You're talking the market. What market?
The market, the stock market, the bond market, the currency market, the commodity market. Well, we use the word risk, and the word risk, most people have only heard of the word risk, but we're going to talk about three big risks, but there's tons of other risks. We'll kind of go into some of them. But the three big ones we're going to deal with is market risk, liquidity risk, and
credit default
risk. Thank you very much. Those are the three big ones that we're going to talk about today. So let's start with market risk. Market risk is, you put your money in something and you lose principal and you realize the loss. So you put in $1,000 and you sell it and you only realize $800 back. Now, that can be caused by all kinds of different reasons, but we're going to just classify that as market risk. So some things of market risk, let's just go into them. So you could put your money in and all of a sudden there could be a panic in the market and you can get scared and sell and you lose money at a lower price. You sell at a lower price, you lose money. That would be considered, I guess you would call it equity risk is a good way to define that, where the markets are fluctuating on a daily basis, and sometimes they can be violent and they can evoke emotion, and you can sell during that market decline, and because you're afraid it's going to keep going down lower and lower and lower and lower. So, we could kind of call that equity risk, but there's lots of other things.
Sure.
You could wake up one day and find out that Boeing had another airplane crash. Unfortunately, and now people are afraid that their latest 737 MAX is a serious flaw, and they don't want to take the risk that more is going to happen, and all of a sudden Boeing's got to scrap that whole project. Now you're
Stock's down $50.
right. Now you're dealing with a business development risk. Something has materialized that was unknown 2 days ago. Yes, they had one crash before, but now when you have two, that's so unusual. Some investors are saying, "Hey, that's too much," So, but you have interest rate movement. So I buy a bond, and I have a 3% bond, which is what the 30-year Treasury is yielding right now.
Right.
And all of a sudden, that bond rates move up to 3.5%. And I can't sit around and wait for 30 years to get my money back. So I thought it was a good buy at 3%. Now it's at 3.5%, and I need my money back. If I'm going to get it back, I'm going to have to sell that bond at a loss. Right. And so that interest rate movement caused a bond loss. And so that's called an interest rate risk.
Yep.
And then you also have currency risk. That's another one. So I buy into the European stock market, and the euro's trading at 130 to the dollar, and the European stock market goes up 2%, but the euro goes down 10%. Mm-hmm. And now I've lost 8% of my money, even though the stock market went up. So that's a currency risk.
Right, currency risk is a very hard risk to really describe well for clients.
Yeah, because
how that relates to interest versus the equities versus the bonds, whatever you're in. You got that other underlying piece to it.
But the concept, though, is that it's the fluctuations of assets.
Sure.
And those fluctuations of assets, and if you sell during one of those downturns of the fluctuation of your assets, causes a loss of principal, that would be called a market risk. That's what we're referring to.
Exactly right.
So that's the first type of risk, is market risk. And we're always thinking about market risk, but, we've learned over time that timing a market risk is very difficult, right? So, if we're broadly diversified in a market, our main goal is to try to determine, is it reasonably priced? Because if it's reasonably priced, even if it's priced slightly on the high end or, something of that sort, investments have proven over time that if you buy in it even a slightly overpriced range, over time it's going to still do okay for you. It's when they get ridiculously overvalued, which would happen to the NASDAQ stock market in 1999, 2000.
From October 98 to October 99, up 100%.
Yeah. And the market was trading at about 100 PE ratio at that time, if I remember correctly. And over that next 3 years, it lost 80% of its value. It went from a NASDAQ index of 5,000 to 1,000. And so that's an 80% decline during that period of time. And if you look today, it's at what, 7,500?
Well, it took 17 years for it to break 5,000 again.
Just to break the 5,000 level again. Sure. And right now it's at 7,500, I think, somewhere in that ballpark. So it's up 2,500 points in almost 20 years. That's not a big move, and so forth. So anyway, that's what we're talking about, market risk. And our job as investors is to determine how we're going to play the movement of those markets. And we're not going to try to time them, but we definitely want to be thinking of the valuations of those markets that we're playing, right?
Sure, that you're operating in. You have to just look exactly right. You want to see, where are you in the cycle?
Where are we in the cycle, and how is market risk? Where does it stand at that point in time? Again, we are not looking to move out of the way of every 10, 20, even 25% movement of the market. It's impossible, and everyone's proven that it's impossible.
No, it just says that you stay away from the tech stocks when you're in that kind of a mania.
Yeah, and that was what happened at that time. Now let's go to the next big risk we're going to deal with is liquidity risk. Liquidity risk is where you put your money into an investment and you can't get it back unless you want to try to find somebody who's going to buy it from you. But when you're talking about an investment that you can't easily get your money back, that liquidity risk is a problem. So, for example, let's say you said to me, Drew, I want to invest in the financial consulate, and I'm willing to put $100,000 into the company and own 5% of the stock. Let's just use that.
Sure.
Your 100,000's in that business. You're not going to get that back easily, right?
Sure.
And so you're hoping that the company continues to do well and that you get dividends and distributions from the company, but you are not getting that money back easily unless we decide to sell the company as a whole. That's called a liquidity risk.
A publicly traded security.
And a non-publicly traded security. And another great example is all the people who run out and bought real estate as rental properties. You don't just get out of a rental property overnight. Yeah. You've got to think
condos and
all those kind of investments where you're buying real estate and you're paying a lot of fees to get into it, and then you got to pay all the fees and commissions to get out of it. It's something that you have to just count on, that you're not going to have liquidity of that investment for a long period of time. And if crisis hits that you need it back, chances are somebody's going to take serious advantage of you and buy it from you for a significant discount to what any possibility it could be worth in the future. And you see that a lot in these non-traded non-traded REITs, real estate investment trusts. The people come along, they're not traded, and they say to you, look at all this great money you're going to make, et cetera. You're going to make 6%, 7%, tax-free even, and so forth. But the problem is that it's non-liquid. And if you want your money back, normally what happens is somebody's going to come in and buy it from you for 30 to 50% of what any realistic value it could have. That's a liquidity risk.
Yeah, the best example probably are timeshares.
Timeshares. That has
be a sore spot too.
That has a whole bunch of risk. Sure. Not only that, but liquidity risk. Once you go into it, you're going to have a hard time getting out of it, and you're just looking to get the value of owning that or using that real estate over a period of time. Let's go to the next big one: credit default risk. That's where you put your money into a bond or even a stock, let's say, and they run into financial liquidity concerns. A great example of this would be during the 2008 crisis. Many institutions ran into trouble. Lehman Brothers was the most popular,
sure,
and they had these bonds outstanding, and they could not meet their liquidity needs because the investment, the loan market to Lehman Brothers dried up, believing that they were an illiquid institution. Lehman goes into bankruptcy, insolvency, and all their Lehman Brother notes and bonds they had outstanding, which were billions.
Even just a prime reserve money market.
You had a money market fund that went under because it had lent a lot of money to Lehman Brothers, and they couldn't. A lot of times when a money market would have a default, they would bail it out. Well, prime market couldn't bail out the amount of money they had lent to.
And so it went under $1. So in the end, they got probably 97 cents on the dollar, but still went under $1. People said you didn't think you could lose money there,
right?
But they did.
But this is
credit
default risk. You're lending money to somebody that goes under, and these are the three big ones that we're going to talk about. But there's a whole host of them. You got concentration risk. Mm-hmm. Reinvestment. Concentration risk is if I have all my money in one stock and it goes into trouble,
or one fund,
or one mutual fund, the S&P 500. Like between 2000 and 2010, the S&P 500 did nothing, 0% rate of return. Well, that's concentration risk. If I had it diversified amongst the world, I would have made a reasonable rate of return over that 10 years. Well, now the last 5 or 10 years, the S&P 500's been the darling. Now all of a sudden, people are getting enamored with just owning the S&P 500. Don't understand or appreciate. Don't appreciate the benefit of diversification, and they're concentrated in one group of 500 companies, assuming it's going to do what it just did the last 8 or 9 years. and not looking at what it did during that 10 years or other 10-year periods of time when it stalled. There's reinvestment risk. I buy a CD or a bond at 5% back in 2008, or I'm sorry, 2005 or 2007, and now all of a sudden it was a 5-year bond. Now all of a sudden it's 2010 and rates are down to 1%. I couldn't reinvest my money back at that same rate of return. And I have to think about that. Sure. If how important is reinvestment risk, inflation risk, what's the purchasing power of my money? So I might be worth $2 million today, but if I put it all in bank accounts and they're yielding 1% or less, and inflation runs at 2% or more, I'm not going to be worth $2 million today dollars 10 years from now. That's called inflation risk. I want my investments to outpace inflation so that continue to have the same purchasing power that I had before.
Exactly.
Horizon risk, the concept that, all of a sudden I think I'm going to be a 5-year investor, and I buy a 5-year bond and it's yielding 6%. And I'm all happy with my 6%. And all of a sudden something happens 2 years down the road that I need that money back. And now all of a sudden I have to get it back. And that horizon has shrunk, and it forces me to sell at a loss, possibly. Not always, but possibly. Foreign investment risk. Now, we just sort of talked about this a little, but foreign investments are great for diversification. But to an American, they bring a double risk to it, because now you have that foreign entity, and you have the currency risk, and you bring it into an emerging market country. You bring a whole group of risk into if it's not a developed sociopolitical
events. Sure,
the protection of assets. Europe, the United States, Japan, Canada, Australia, England, they all have significant history of protecting the ownership of assets.
Right, they're not going to nationalize.
They're not going to nationalize, but there are countries that have done that. Even China, who's emerging as a great capitalist nation to some degree. There's still a lot of the big companies in China are owned by China. They don't own the whole thing, but they have a significant influence in the ownership of those countries. So foreign investment risk is something that is clearly something that we're worried and thinking about at all times.
And all these are just to be aware of them. You have to understand what the risks are.
We're getting to the main point, the universe of investments, and that's where we're getting to. Exactly right. And we're just going over. We're even just skimming over some of these risks that we're talking. We didn't even address a big one that a lot of people are talking about today in today's world: volatility risk. Sure. Volatility risk is when the markets are doing this, and it creates the emotions. We sort of mentioned it in the market risk, but that volatility of an investment can drive people crazy. Watching those movements, it can get you overly excited on the way up, and it can get you overly scared on the way down.
Come off what you've set to do, things you've set in motion.
Why did you do that? But the last one we wanted to just talk about is business risk, and we sort of addressed that. Like in you take a company, well, Boeing. Business risk. You have a company that's put a lot of money out into this new airplane, and all of a sudden, there's things going on that you're concerned about.
Sure. I think about Toys R Us.
Right? Toys R Us.
Great company, overextended themselves. Internal decisions they made. And you could say that part of that maybe was the internet, but the biggest risk, the biggest problem they had was they overextended themselves.
They sure did. And somebody said it really well, that, Amazon was clearly a threat.
Sure. But
Toys R Us did not reinvent themselves, because as well as I do that if you can figure out how to get parents and children into the store, they're going to buy things.
That's
they're not going to wait until it comes
even a day.
They're not going to sit there and say to their 5-year-old, "Look, Johnny, this doll or this train is on sale at Amazon for $3 less." We're not gonna buy this one. we're going home
me
and
to the
order it,
store.
and 2 days later,
No.
you're-
I'll go to the store
anybody
now.
who's a parent who has a child around that age knows you're going to buy that train right now.
Yeah.
Johnny wants it.
It's a business decision, business risk. Yeah.
You know, so it's understanding and you know how that company is run, business risk. Okay, so now we built this up. So now let's take off. You ready?
Sure. Yep.
So the universe of investments. Everything in life, everything in the investment world, or everything in life actually, is based on supply and demand. You know, you tell me anything that financial advisors, you know, how do we charge? It's based on supply and demand. You know, if there were a lot less financial advisors in the world, we may be able to charge even more money for what we do. If there were a lot more doctors, maybe we would pay even less for significantly less. So the more toy stores there are, the cheaper the toys are going to get. Supply and demand, everything.
Lawn cutting.
Lawn cutting, you name it.
One thing after another. Lemonade stand.
Medical, you know, medical care, you know, it's supply and demand. It's you know,
and that's another whole topic because
another whole
supply
topic.
and demand has been twisted there.
Not to mention that because of what medical care is, it literally almost has an unlimited demand, right? Because who wants not to have the greatest and greatest and greatest and more and more and more and more healthcare, you know?
Sure, but you want, for instance, college education. So you get all this loan money, and now you've got all this money now you can throw at tuition. What's going to happen to tuition prices?
Well, just what the universities have done, supply and demand, okay? So is the investment world also driven by supply and demand? Well, most people would say, yeah, of course, but there is a center of the supply and demand. It's called the risk-free rate of return. In other words, if I said to you, Chris, I'll give you 2% on an investment for 30 days with no risk whatsoever in US dollars, traded in US dollars, I'll give you, and every 30 days it'll mature, and I'll tell you what the new interest rate is. And likely that interest rate, if it's 2% today, 30 days from now, it's probably going to be somewhere around 2%. And so there's no risk, and it's the United States government, so it's absolutely guaranteed. You're not going to lose your money. Now there are a lot of people out
Full
there.
taxing authority.
There are a lot of people out there
Sure.
laughing right now that the United States government is risk-free, but for the most part, in today's world, it is truly risk-free. Or, Chris, I'll give you an investment that will either pay you 2% or you'll lose 100% of your money. What are you going to do?
Yeah. Right.
That's a pretty easy one,
Sure.
right? Now, what if I said to you, Chris, you could make 10% or lose 100% of your money? You might
paying a little
think
bit of
about it,
attention now.
but really not. It's
No,
not gonna.
just-
That's not gonna entice you. I'm not
If
gonna.
you went from 2% to 10, okay, it's like, okay, you're headed in the right direction.
Well, what if you made? You could make an unlimited upside potential or lose all your money, and you've done your research and you feel that this company is a reasonably good company to bet on. You might do it, right?
Sure.
Right, because you're comparing that thought of the investment you're thinking about making with that risk-free rate of return. And it
should be.
Every investment you make
Right.
should always be thinking about what is the risk-free rate of return before I make a decision to do anything that would have a potential higher rate of return, but also a potential negative rate of return.
And the big thing is when people start promising you more than the risk-free rate of return and use words as if guarantee, can't lose, those sorts of things, that's when you stop.
That's exactly the point that we're getting to. There's two sides to the universe of investment. Number one is to think about why are we investing in what we're investing. Mm-hmm. To determine if it's something that we feel is worthy of taking on some form of risk. And the other side of it is when somebody's telling you something, or you see something that looks attractive as an investment, it makes you pause because you're saying to yourself, wait a minute, the risk-free rate of return is X. Why are they offering me X plus Y? That's the concept, right? And so all of our clients should always know, and we ought to make this we've got Mikey, our COO, sitting over here, and he's the one that usually, when I come up with these ideas, he's usually the one that implements them. Every time we put out a pulse, we should put the risk-free rate of return down on that pulse.
243 today.
243 today. That's the risk-free rate of return right now. And everything's got to compete against that. So every month when we put out our pulse, we're going to put down the risk-free rate of return is 2.3%. So that when our listeners, when our clients look at that pulse, they say to themselves, well, 2.3%, I just heard so forth and so forth is giving da-da-da-da-da. And now they should be thinking immediately, well, the universe investment tells me that if this is 2.3 and they're saying 3 or 4 or 5, why? And now you start running through your risk. You run through all the different types of risk. Is there a business risk in this? Is there a liquidity risk in this? Is there a currency risk in this? Is there a market manipulation risk? What's a market manipulation risk? That's one I just made up, actually. I don't even know if it's an academic one, but I just made it up.
Well,
a market manipulation risk would be where a company is using words to attract you to something, make you feel that something is doing something that it's not doing.
Advertising do that? No, for sure. Of something that even if you don't know what that is, but the fact that it's offering you more, you start asking the questions until you identify what the risks are.
Yeah, and so let's go through some examples, okay?
Sure.
So a great example where the risk-free rate of return would start.
Well, I was just going to say one that I think it's easy to get the higher rates of return, but something like the stable value funds or the guaranteed investment contracts, where they're not promising you a ton more, but they're promising you a little more.
That is true. So you see this a lot in 401k plans, stable value funds, and they used to call them guaranteed investment contracts or guaranteed income funds or something like that. They changed the name to stable value funds. Why?
Because they were not guaranteed.
And they found out that using that word guaranteed when they weren't, if something went wrong, you're the company who told them with the word guaranteed that you're on the hook for what was not guaranteed. Right. So that's why the name has changed to stable value funds.
So the great example of that was 2009 when the Chrysler stable value fund only paid off 89 cents on the dollar.
Right. So when I heard about stable value funds and they were yielding more than the risk-free rate of return, I wanted to know, well, what the heck is a stable value fund? And so you begin your research. So here's what I found. When I went into a stable value fund, here's what was the research. Number one, they were all long bonds. Well, you're thinking long bonds are risky. Right? Because if the interest rates go higher and these bonds have lower yields, you could lose money on that interest rate movement. Long bonds have liquidity risk. If I have to sell it because people want their money back from the stable value fund, I could lose money and so forth. So first I'm thinking, okay, these are long bonds. So why is there stable value? The next thing I found is that they would sell derivatives. What are derivatives? They would go to banks and brokerage firms and say, guarantee to us for a certain amount of money. So it's an investment trade between the two where they say, I'll pay you umpteen millions of dollars to guarantee that if interest rates go higher and these bonds go lower, that you'll make good on the loss of the bond interest rate movement. So that's called a derivative, an interest rate risk derivative. They'd make this investment with them. So they take some of the interest they earned on those bonds and they place a derivative bet with a brokerage firm or a bank to guarantee that if interest rates move higher, you won't lose money. Then the next thing they did is they said, well, we'll go to another institution and we'll say, and if one of these bonds defaults, you're going to make good on the default. So they take more interest money. So the concept was that they'd be making 4 to 5% rate of return, but they would take 2 to 2.5% of that rate of return, and they'd buy these derivative contracts that would bring the rate of return down higher than what you could get on the risk-free rate of return. But it's this complex menagerie of long bonds and derivatives put together. And what happened to Chrysler in 2009 is they had some of their derivative risk with somebody who went under during the 2008-2009 crises. They couldn't make good on guaranteeing them the default risk or the interest rate risk. The derivative contract went under. Therefore, the bonds had to be sold at losses without recovery from the derivative contract, and that's how they lost money. My mind said to me when I read all that, I said, too complex and too much no transparency that I can figure out what really they're doing, that I just don't want to take. I don't want to take the risk. I don't like not being able to see what's going on to understand.
And the worst part about it was that stable value makes you think that they're doing safe things.
Yeah.
They're doing stable things. Derivatives, again, there's
long bonds with derivatives and so forth, not a game that I was willing to play. We actually, we try to discourage clients.
Well, some people get the stable values. They have insurance companies, and they have maybe 10, 15 insurance companies with different contracts that are coming in and
right. But we don't
different
know.
ways, right?
Yeah,
you've got to find out.
You can't get that information as easy. So we just, stay away from stable value. I'm not saying that anybody shouldn't.
Right.
I'm just saying that there's a lot more complexity to a stable value fund. And if you had a 2.6% rate of return on a stable value fund and a 2.3% rate of return on a U.S. money market fund, which a lot of 401ks now offer because the yields are up now,
Yep.
I would go to the money market fund. I wouldn't be sitting in stable value. You shouldn't even be in your 401k. You probably shouldn't be in stable value with much money anyway. You should be invested for the long haul in your 401ks. Let's go to another one.
Sure.
I want to just say something, and that is that, all of our people listening can write questions in, call questions or anything. I'm not call questions in, but they can write questions in anytime. I don't want you to feel like you have to just sit here and listen to us babble.
I was hoping it was more than just babble.
We're not just babbling, Chris,
Sure, no, yeah, exactly right. Get them to...
But, feel free to ask a question. It's the little box there. You should be able to see that. You can feel free to ask or, chat, and Mike will get it to us if you send us one. So let's go to another one, annuities, okay? You get a lot of people. And remember, we talked about earlier that the word annuities thrown around a lot. We're not talking about teachers or hospital tax-sheltered annuities, 403Bs. That's not what we're talking about. We're not talking about lots of different types of annuities. We're talking about the annuities you normally hear advertised on television and radio and in magazines and so forth, saying that you're going to get a bonus of 5 or 6%, and you're going to get a 6 or 7% growth of your money over time, and you're going to get a guaranteed payment of 6 or 5 or 6%, and all this kind of stuff. Boom!
Right away, the flag should go up.
The flag goes up,
internal.
And you say, "Wow, what the heck are these?" And first off, it's an insurance company, the least benevolent of all groups out there. Well, I don't know. Maybe brokerage firms go, above them, but the least benevolent, they're certainly not interested in trying to make their clients wealthy. Insurance companies, they're trying to make they want to make people feel secure. That's what insurance companies are about. But the biggest thing that insurance companies do is they try to create products that overcome objections to get people to buy
That's their
based
history.
on what they're thinking about,
That's their
overcome
history.
objections. And so people saw the stock market go down like it did in 2008. It scared them. And insurance companies came out in droves with these annuities that said, we guarantee you'll never lose money in the stock market, and you can make the market's upside return. You guaranteed not to lose anything. You're going to get a 6% bonus. You're going to get a guaranteed 6% withdrawal. You're going to get, and you're thinking, this is too good to believe. The Universe Investment says, boom, it is too good to believe. So do the research, figure out what's going on. So here's what's going on. Liquidity risk. They buy these annuities. They normally have 10% sales commissions in them. So, if the company has to pay somebody 10% to sell an annuity, if it's really good, you should be able to just put it on the internet and they'll just, pick it up like there's no tomorrow. Is that the history of the internet, right? Somebody's got a good idea.
Sure.
You just put it out there on the internet and people will just buy it by the billions if it's a really good idea. But they're selling these securities, and if somebody puts $100,000 with him, with that broker, the broker will get $10,000 up front, and the insurance company saying to the person that bought it, you're not going to pay that commission, we're going to pay it. Okay, so you're really thinking, how does that work?
Sure.
How can they pay that and so forth? So, and they give you a bonus too, of 6%. So here's how it works. So first off, it's a liquidity risk. They all say in the contract that you are locked in for a period of time. And if you get out in that period of time, you're going to have a surrender charge. That surrender charge could be as low as 6%, and it depends on the commission paid up front, or it could be as high as 10, even I've seen as high as 15% surrender charge. And I've seen the surrender period go as long as 18 years, and I've seen them as short as 6 years. And again, it just depends on what they're offering and so forth. But the typical one you see is 10 years, 10%. And what happens though is if you leave that contract in that 10-year period of time,
change your mind, want to take your money out, put it somewhere else.
They're going to take a fee back, a surrender charge back, and it's normally 10% for the first 3 or 4 years because they want to recover the full commission, what they paid the broker. And then after that, it starts to gradually decline, 8, 6, 4, 2, something like that. Finally, in the 10th year, it's down to 0. But they also say that during that 10-year period of time, if you leave, not only are you going to give the surrender charge to them, but you're going to forfeit your bonus. Okay? Your 6% bonus is forfeited. Okay, so why? Well, if I just stay 10 years, then everything's good, right? Well, here's the key. In that 10-year period of time, they're charging fees.
Sure.
And the fees can be as high as, and if you look into contracts, 2 to 4% per year. Let's just say it's 3. Let's take the middle road, 3%. Over 10 years, they made 30%, right, in fees. They gave you 6. They gave the broker 10. They still net 14, right? Who paid the bonus?
Yeah.
You did,
right?
Who paid the broker commission? You did. But the liquidity, forcing the liquidity, forces you to make sure the insurance company has the money to pay everybody what they got, making you feel good. You got your bonus, but you don't realize that you ended up paying it. Okay, so what's all that other stuff, though? What about the 6% guaranteed? All it is a 6% guaranteed withdrawal or a 5% guaranteed withdrawal. So let's say I have $100,000 and they guarantee me a 6% withdrawal. That's $6,000. Let's say my money is growing by 2% per year, and they're giving me 6% per year.
Sure.
And over 20 years, they gave me $120,000, right? But my account really only grew by 2% a year. I might have 0 at the end of 20 years. And now I die thinking I'm going to leave $100,000 behind or more to my family, and actually nothing. And all the insurance company cost them over 20 years was $20,000. Not a bad deal for the insurance company, the guaranteed withdrawal, and making people feel like they're getting an actual rate of return on their money. Now, you also hear these things about how your money's growing by 7% or 6% per year, but that number is actually what's called an accumulation fund. An accumulation fund is a theoretical account that if I put in 100, my money over here is growing by some either fixed interest rate or by some form of index that's probably limited to no more than 5% rate of return per year, depending on how the stock market does, minus fees. Okay, you always minus fees. And then what happens is this accumulation fund is growing, but all it's going to do is determine what your guaranteed withdrawal is going to be. And it's not your money. You can't go back to them and say, hey, that accumulation fund's worth $200,000. I want that $200,000. And they say, no, look over here. Your account value says $125,000. That's your real money. That's what you can have now. This is just, we use this just to determine your guaranteed withdrawal that will start coming off of your account if you ever implement it. And so it gets kind of complicated, but when you understand that this is an advertising risk, this is somebody using marketing to lure you into something, Universal Investments again tells you, do your research sincerely to, until you fully understand what all the risks are. So let's go on to another one, Bernie Madoff. And
we say just Bernie Madoff because right away everybody who's talking about investing money has heard of what happened to those poor folks who invested money with Bernie Madoff.
Correct. And he was a Ponzi scheme. Yep. So what's a Ponzi scheme? You take in people's money and you guarantee them a certain rate of return. Now he wasn't quote unquote guaranteeing it, but he was pretty much telling people that my track record has been 8% per year of income, period. And so he did that, 8% per year. But really what he was doing is he was using the new people's money to pay the old people. And he kept, as long as he kept building a larger base, like Social Security system.
That's another subject.
But that's a little different, but it's not much different. Anyway, so as long as he kept building a bigger base, you can keep this going, or until the Fed figures out what's going on. And so, I feel bad for the people that were hurt by Bernie Madoff, but the Universal Investments has helped me once to identify a Ponzi scheme for a client that was invested in something. But, it should have helped people to know that Bernie Madoff could have been a Ponzi scheme, because he just kept doing that. Even as rates kept going lower and lower, he just kept pumping out that same amount of money. And you really had to do the homework to figure out, well, Bernie, what are you really doing that's making this money? I want to see that. Don't tell me, I don't want to hear from others that that's what he's been doing. I want to see, what are you doing? And if I can't see it, figure it out and understand why it's working, etc., I don't want anything to do with it. Do your homework.
Yep.
The
S&L crisis, it was a local one. It was a big one. That
the Maryland S&L crisis was exactly where the Universal Investments came from. So it was 1984, and I was a young advisor, and the Maryland S&L's Old Court Savings and Loan. Yep. I'm sure a lot of our Maryland listeners right now remember this. Eastern Savings Bank. I can't remember what a couple of the other big ones that were really paying the higher rates of return, but they were doing huge amount of advertising, and they were offering significantly higher rates of return than the federal banks, which, started. Now, they hadn't always been. They had always been just about a half a point over. And all of a sudden in 81, 82, 83, 84, somewhere around there, the spread just kept getting wider and wider and wider and wider. And I started thinking, as a young advisor, saying, why are they offering so much more? So I went to do some homework, and somewhere, I don't even remember where, someone explained to me that the Maryland banks are insured by MSSIC. And I said, well, isn't that Maryland Guarantee? And they said, no, it's a fund that's the Maryland banks,
Right.
and there was no Maryland behind it, even though they took the Maryland logo and reversed it. So it made you think that it was Maryland
I forgot about that.
state guaranteed.
Yep.
And but it wasn't. It was just a cooperative account that was formed by the Maryland banks, and the Maryland government oversaw the concept and said to them, you ought to do this as a way of guaranteeing, if one of you goes under or something, there'd be money to bail them out, just like the federal government, FDIC.
Sure.
FDIC was never originally insured by the United States government. It was implied, but it was never guaranteed until George Herbert Walker Bush unconditionally said, no, from now on, FDIC is unconditionally guaranteed by the United States government. He mandated that during that federal S&L crisis
in the early 90s.
When I saw that the Maryland S&Ls yields were going higher, doing the homework, came up to the understanding that the Maryland Savings Share Insurance Corporation, or whatever the heck they called themselves, MSSIC, was not significant enough. And here's the other thing I understood. This is another key point about market risk and so forth, is no financial institution can survive a run. That's a concept that you have to always understand in investing, is no financial institution can survive a run. What's a run? It's I'm Bank of America, and all of a sudden depositors go to Bank of America in hordes saying, I want all my money out immediately. I don't want to wait another minute. I want it out now. Why is a run impossible to survive?
George Bailey explained it, and it's a wonderful life because your money is in his house.
That's right. Yeah, but it's a lot cuter the way he said it that made people want to leave their money in the bank. But at Bank of America, it's all over the world. It's invested everywhere. Yep. And all they ever have is 7, 8, 9% of your money available that they can get. So if more than 3 or 4 or 5% of people come asking for money, it can easily cause them to have no liquidity to meet their obligations and immediately begin to shut the doors down to close the bank. That's called a run. And once I understood that the Maryland Insurance Corporation could not handle a run, the FDIC can. Why can the FDIC? Because they have the full firepower of
taxing authority
and printing of power of the United States government and the Federal Reserve.
If taxing fails,
which is what saved them in the 2008 crisis. You had a financial run on the world markets, but what saved them is that they had the firepower to create the confidence to stop the run, to say, no, we're just going to keep giving you the money, and no matter what amount you need. So stop running on the banks and so forth.
Which kind of happened in '87. Greenspan just flooded the market said, "We're here.
We're here.
We're here to give you as much cash as you need."
So the universe investment is when you hear somebody or see somebody offering a little higher rates of return. But there are anomalies, okay? So let's talk about those real quick. The yield curve right now is inverted. So this is unusual. Right now, what did you tell me? The 1 year?
The 30-day is at 243. The 30-year is at 299 today. But the 1 year, 3 year, 5 year, 1 year, 2 year, 3 year, 5 year are all lower than the 6 month.
They're all lower than the 6 months, which doesn't make any sense, because if you're investing for a shorter period of time, you should be able to get you should be able to get a higher rate of return for a longer maturity.
Right.
So if 6 months is 2%, I put it out for 2 years, I should get 2.3, 2.4 or something like that.
I think the 6 month is at 255, and then you go down, you don't get above 255 until you hit the 10-year, which is at 264.
All right. So just think about that. In 6 months, you're getting 255, and if you invest for 10 years, you're getting 0.09% more.
Right.
That doesn't make any sense, and that's an anomaly.
Yep.
But how does that happen? Why does that happen? The answer is the Federal Reserve. The Federal Reserve gets concerned that inflation is heating up, and so the Federal Reserve pushes short-term interest rates higher through what they call their Fed funds rate. They push the Fed funds rate higher, and it flattens the yield curve out. And nobody's going to invest money or ask for less rate of return than what the Federal Reserve is trying to get. The federal firepower you out of that. Mm-hmm. And so when you have these kind of yield curve inversions due to the Federal Reserve, then you're going to have a situation where you're going to have these anomalies where the reason the longer guys are out here at these higher rates is because they believe the short-term rates are going to flop back down again.
Right.
And that's going to make them wise to be invested for 10 years at 2.7%, because if this flops back down to 0.5%, they're going to look like geniuses out here in 10 years.
And they're thinking the short rate is going to drop because the economy is struggling.
Right.
It's going to be struggling more. So you need short-term rates to drop.
Another great example of an anomaly right now is online savings banks, which we're telling a lot of people to participate in online savings accounts.
Right.
They're FDIC insured.
Yep.
My Savings Direct is offering 2.4%. Ally Bank's offering 2.2%. I used Capital One 360. They're offering 2.2% right now. But the local bank savings accounts are only offering 0.1, 0.2, 0 even in some situations. Why would there be such an anomaly between the exact same type of accounts? FDIC insured, M&T versus My Savings Direct. They're both banks. They've both been around a long time. They're both FDIC insured. Why such a difference? The answer is brick and mortar and inertia. So M&T knows that there's inertia, that nobody's going to leave them quickly and easily. They had lower rates. They couldn't. They had to keep their rates low, and so they found that people weren't leaving them. So why raise them?
Sure.
Whereas the online banks want to compete with them, and they don't have all the brick and mortar. They don't have all the people that they got to pay. They're just strictly an online bank, and they're attracting people by just offering the risk-free rate of return, 2.2, 2.4%. That's the risk-free rate of return. These
aren't fly-by-night organizations, by the way.
No.
Ally Bank is the old GMAC.
GMAC, Capital One 360 is Capital One. Sure. And My Savings Direct is Emigrants Bank that's been around since 1864 or 1858 or something ridiculous like that. So another way to look at risk is, I could lose the risk of my principal, I can lose the risk of my purchasing power, I can lose the risk of I can have a loss of liquidity and getting my money back, or I lose my opportunity. Those are the big things that we're looking at, thinking about, and those are the things when we see somebody offering us a higher rate of return, we want to say, risk-free rate of return 2.4. Why are they offering? And I got to go through these risks. Am I losing liquidity? Am I losing opportunity? Don't just trust the person you're talking to that's selling it to you or talking to you about it or advertising it or whatever. Go through that and understand it exactly. What risk are you taking when you make an investment? So
it's always the unforeseen thing that can get you, and that's what we do throughout our practice. You've done that from the beginning. What we do is to try to uncover risk and cover the risk as best as possible.
We talked about it years ago in the 1990s. We said money market funds, because you can't survive a run. Money market funds one day will have a run. In the 1990s, we said that. Well, there were no runs on money market funds until 2008, when Prime Money Market Fund had a run because they had a lot of Lehman Brother bonds and they couldn't handle it, and they had to close the.
Sure, anything else that happened before then, we had some losses, but the sponsor always came in and made and supported the price of $1 per share.
Which created the psychology to say, don't worry, investors, we got this under control.
Yep.
But that can only happen for so long. You need that firepower of, you need that firepower to stop a run. Anyway, the concept of the universe of investments is understand what the risk-free rate is.
Yep.
You're not going to get a free lunch. There's no such thing. And understand, what am I missing? What information is there? And make sure you find somebody without an economic bias to find out, do you have the full picture before you make an investment thinking?
It's been a 35-year principle that's guided you.
It has. It's one that I really regret that we haven't really sat back and taught our clients about. And, from this day forward, hopefully, anybody who wants to learn more about investments will be able to come to these different webinars we do, the articles we're going to write, and be just as aggressive in teaching about investments and investment principles as we are about financial planning and financial planning principles. So, I don't know, we rambled a lot there, Chris, so we probably didn't give anybody a chance to ask any questions. There are no questions right now, but if there are, we can wait a little longer and see if anybody does want to ask a question. Are we on a strict time frame? No. So if there are any questions, feel free to ask them, or if not, you can just email them in, and then we'll disseminate them with the webinar, because it's going to be posted. So if anybody couldn't stay the whole time, or I don't know why I'm telling somebody who couldn't stay the whole time that they could watch the video.
They're going to come back and get it. They're going to come back and listen to the end part.
And then at the end,
I just want to ask a question about, when's the Pulse going to first come up with the risk-free rate? It's
going to be the end of this month. It'll be there. I guarantee it. It'll say risk-free rate of return for you watching the universe of investments and so forth.
I just think that's a great idea.
Anyway, if there are no questions, we're just going to wrap it up here. We appreciate your listening. Sure. This is Drew Tignanelli saying God bless.
Good night.